Hey, what's up, my friend? So welcome back to this week's video, right? We'll be talking about how to trade semi-naked, right? So last week we spoke about, right, how to trade naked, right? So a lot of traders like, woo, naked, it's really gonna be naked. But no, I have my top on. And in fact, this week I even wear a shirt because I have an event to attend later. So trading semi-naked, so this basically means that on your chart this time round, right, besides your support resistance, right, you're gonna put in a little bit of indicators to help you make your trading decisions a tad bit easier, right? So indicators, they are useful in the sense that, yeah, most of them are lagging, but they help summarize past price action into lines that, you can pretty much interpret easily. So in today's video, I'm going to share with you two indicators, right? The moving average, on how you can actually use it to define value, and the stochastic indicator, right? This is an indicator I don't talk much often, right? And this indicator can actually help you better time your entries in trending market, right? And also the pitfalls to avoid when you're trading indicators. Right, so all this and more in today's video. I'll see you there. Okie dokie. So right now you're looking at a chart of dollar yen daily time frame, and we'll be learning, right, how to trade semi-naked, right? If you recall, last week we talked about trading naked, right? Nothing on the chart but just, plain support resistance, right? This week we're going to add a little bit to the charts, right? A little bit of a so-called indicators, right, to help make sense out of your trading. And I've got one very simple rule, right, for any traders who wish to add indicators to your chart. And the rule is this, is that you must understand how your indicator works. This means you must know how the value of your indicator is being calculated, right? What makes the indicator go up or down, or or not move at all, right? This is so important, right? It is not responsible of you for you to just put an indicator down there, and if it goes up you think it's a buy signal, and it goes down it's a sell signal. It doesn't work that way, right? You need to understand how the values are being calculated. Only then do you know what's the objective of your trading indicator. Alright, so let's talk about this market for a while first. Alright, dollar yen, this is the daily time frame. So if you recall, right, the way, if you want to trade naked, you just plot in your support resistance, right? For example, this one over here, here, and maybe here. I didn't really, fine tune it, but you can see generally, you can see that, we have quite a number of touches at this level, and this level. So that aside, right, for traders who wish to add a little bit more to their charts, right, there is another way to define support resistance, right? And it's what I call dynamic support resistance. In a sense that this time around your support resistance isn't a straight line, but rather it moves together with time, right? Because if you understand, right, earlier the support resistance, let me change to black, the previous support resistance we draw, these are pretty much static, because no matter how much time has passed, this level is going to hold. But if you talk about dynamic support resistance, right, this could be in the form of a trend line, for example. Trend line, let's say we draw a trend line, right? You know that as time progresses, this level move as well, right? Another alternative is moving averages, which is what we're going to cover right now. So moving average, one of the most common question I get from traders is this, right? Hey, Rainer, which is the best moving average out there? And the truth is that there isn't a best moving average out there, right? It really depends on your trading approach. If your trading approach is like more long-term, right, you're trying to catch a longer-term trend, then it makes sense that you use a longer period moving average, right? But if your trading is more shorter-term, perhaps you just want to capture the momentum of the markets right now, then it makes sense to be using a shorter-term moving average, right? So there's really no best or worst one out there. It really is a matter of you finding the right moving average that suits your trading style. Okay, so for me personally, I like to use the 20 and the 50 period moving average. Not that there is anything magical, but rather these two moving average combined together kind of give me a zone, an area where the market may find value, right? So this is the 50 period moving average, this blue line, and I'm going to get the red one right now, which is my 20 period moving average. And another question I get from traders is, Rainer, should I use exponential? Should I use simple, smooth, linear, weighted, blah, blah, blah? Again, it's not really going to make much of a difference, right? For me personally, I stick to exponential moving average, right? There is no best type of moving average, right? Whether is it simple, exponential, etc. But again, find the one that, suits you. So you can see on this chart over here, I've plotted in both my 20 and 50 period moving average. And one thing that I noticed is that this market this particular market tends to trade beyond the 50 period moving average, and then it moves lower. What do I mean by this, right? You look at this over here, right? It tends to exceed the 50 period moving average, and then it collapses lower, right? This one over here as well, a little bit, right? Exceed by a little bit, and then it collapses lower. Exceeds the 50, then it collapses lower. Exceeds the 50 period moving average, collapse lower. Exceed the 50, and then it's traded lower. Okay? So here's the thing, right? So since I noticed this pattern that is occurring on this particular time frame and market, I would pay attention to how the market reacts should it exceed the 50 period moving average. Again, because there is a possibility that it may reverse from that area, right? So in this instance, I'm not really going to pay attention to the 20, right? Because it is something that is not really too respected by the market. I would say the 50 is a more apt moving average to use, right? Because this is clearly the one that is being more respected. So you can see over here, so needless to say, if the market comes up slightly higher, say around here, right? You know that this is a potential area where the market may reverse because it has exceeded the 50 period moving average by a little bit. But what I want to caution is this, is that again, you don't just treat your moving average as just, signal to buy and sell. You also want to use it in the context of the market. So if you think about this, if you are going short somewhere here, right? Say around here, where is the area that buyers may potentially come in, right? They will possibly come in near this swing low over here. So if you look at from a risk to reward standpoint, there's really not much meat left in this move, right? Because it's pretty tight consolidation. So I wouldn't really, just want to go short the moment it just hits the 50 period moving average. So this is where a little bit of common sense comes into play, and not just rely entirely on your trading indicators, right? I think this is a mistake I see a lot of traders making, just treating it as buy sell signal. No, right? Ultimately, you still want to look at price, right? You look at where a potential opposing force will come in, right? In this instance, where potential buyers would come in, and from there you weigh your risk to reward. Does your risk justify your reward, right? So you use a little bit of common sense. So if you ask me, a better area to go short would be here. Right over here, right? When price retraces higher, right? So now you have a confluence of this previous high, previous resistance, right? You can see it tested once, tested twice, break below this little support, turn resistance, and then if it trades up higher and it collapses lower, you have a confluence of another factor, which is this resistance, and possibly this false break of the 50 period moving average. And if you were to go short from here, right? If you have a short entry trigger from here, now you have more meat in the move. You can see that this is your potential, your first target, right, to the nearest swing low, right, where buyers may come in. There's bigger, I would say, meat, right, so-called meat. I like to use the term meat, right, in the move. Okay, so you can see the difference between shorting at the 50 and waiting for price to retrace deeper, coming into this highs over here. All right, so I hope this kind of makes some sense into you. So let's talk about the next market, right? So you can see that earlier we talked about the daily time frame, and it's pretty much, I would say, universal, right, using the moving average. So for this example, you can see that this is the 30-year treasury bond, right, the weekly time frame. And again, I just plot in this 2050, right? This is the 20, this is the 50, right? Do understand that it's not going to work all the time, right? Sometimes the market will just whipsaw through, especially when it's in a range market, right? So in the trending market, this usually works best. So you can see again, right, this market is clearly respecting the area between the 20-50 period moving average, right? Of course, I don't trade off the weekly time frame because the stop loss is too large for me, right? Because it takes too long for the trade to play out. So, but then again, you can actually use this information and trade on the lower time frame. So on the weekly time frame, you know that we are at an area, right, where price tends to bounce off, right? You have this again, just look at the charts and you can see that historically is, bounce once, twice, thrice, 4 times, 5 times, and right now we are in again. So there's a good chance it could retest this highs over here, right? So what you can do is go down to the daily time frame and you look for long entry, right? So last week was it last week? I'm not sure when. A few weeks ago we talked about this level over here. So you can see that now we have a confluence of the weekly, right? Price is in an area of value using the moving average, and this is then area of support, right? And we got this nice bounce over here. So entry trigger, there could be a few, right? Some trade, candlestick patterns, right? You have maybe this big bullish bar, you can go long, right? It stops below the low, or some traders use maybe a chart pattern on the lower time frame, like maybe a triple bottom, double bottom, etc. So you can see that how this level plays out, and from there you can actually use the hindsight on the higher time frame to make decisions on your lower time frame. Okay, so this is how you can use moving average, right, to help you identify area of value. And last but not least, right? Again, I didn't talk about the calculation of moving average, but I assume that you know how the numbers are derived. Basically, they take the X number of periods, right? Then they calculate the close from it, and they just divide it and get an average, right? So another indicator that I want to introduce, right? I don't really use this, but it can be useful in the trending market as well. It's actually the stochastic indicator. Okay, stochastic indicator. I'll be using a 20 period since this is a daily time frame, and in a month you have 20 days. So I'll put OK. So you can see that this is the stochastic indicator. So what traders do is that, you know, oh, they say price is oversold, I go short. This price is overbought, I go long. Price is overbought, I go short. Price is oversold, I go long, right? And this price is oversold, I go long. Price is oversold, I go long, right? But for me, a better way, all right, if you ask me, to use this stochastic indicator is to trade it with the trend. So what this means is that if the market is in a downtrend, right, then you only look for overbought areas, which means we're only focusing on this portion over here, right? Because it makes sense, right? In a downtrend, you want to be shorting the market. So where do you short, right? When the level is overbought, right? So one thing to share about stochastic is to understand, you know, how the numbers are derived. How does all the lines, you know, why is it 80? Why is it 20? So let's do a very simple example, right? Let's say it's a 5-period stochastic, right? So it's a 5 bar, right? 1, 2, 3, 4, and say maybe 5, like this, all right? Let's say the low is, let's say it's $50, right? There's a high over here, let's say it's $100, and it closed, let's say $90. Okay, so this should be bearish. So how does this 5-period stochastic number is derived? So what they do is they calculate the range from this here to here, right? Right, from the open to this close, divided by from the open to the high. Sorry, I mean the low, right? If there's a low, right? The low to the high of this range. So you're taking basically 90 minus 50 divided by, since the high is 100 minus 50, right? Why 90? 90 is the close over here. 50 is the low of this 5-period bar. 100 is the high of this 5-period bar. So in essence, what you're doing is just taking the range of here divided by this range over here. Okay? So you're going to get 40 divided by 50 is equals to 0.8, right? You multiply by 100, you get about 80%, which is the stochastic value of 80. So that's how you get your stochastic value, right? It's important to understand the math behind it, right? So you can see that in this example, right, if the markets go back into this overbought area, then this would be a prime candidate to go for shorts. So as I mentioned earlier, if you recall, I said that I don't want to go short near the 50-period moving average because there is not much meat left, right, near the lows. So I guess objectively the stochastic provides this information for you because right now it's pretty much a oversold. So you don't want to go short near oversold, you want to go short near overbought, right? But I don't use stochastic, right? As I've mentioned, I mainly look at price. But for traders who wants to, you know, use an additional tool, I would say the stochastic can be useful for starters, right? So again, right? So if price were to come back towards this highs over here, right? Then chances are you can expect this stochastic to come back towards this overbought area, and it's a much better level to go short, as I mentioned, because you have more meat left in the move. Okay? So that's all I have for you in today's video, right? I hope I give you some insights into how to use indicators, right? There's really a lot out there. You have what? Force Index, ATR, RSI. There's just way too many, right? And there's really no point in learning every single one of them or using every single one of them because your chart is going to look something like this. It's going to look ridiculous. Okay, you have Bill Williams, alligator. What is this? Is there a shark? Volume. There's no volume in FX, but maybe this is just from the broker, Bollinger Bands, and maybe, you know, some trend lines. And yeah, how are you going to trade with this? I mean, look at this. Just look at this. Right, how about Ichimoku, Bear Power, Bull Power. Whew, just look at this. How are you going to trade with so many indicators? I mean, I don't even know what to make of it. We can try. Look, okay, stochastic is oversold. ATR is pretty average, so there's not much volatility. ADX shows that the trend is flat. Volume shows that it's a little bit picking up. bear shows, bear power shows, how do you even interpret this? I'm not sure, man. So yeah, it's difficult to, even make a trading decision. So this is what I mean by, don't paralyze yourself with using so many indicators, all right? Just use one or two that makes the most sense to you and helps with your trading decision. Ultimately, it must help with your trading decision. If it doesn't help, then chuck it away. There's no point using it, all right? So yeah, that's all I have for you in today's video, right? Think about this, right? And if you have any questions, any queries, just leave it in the comment section below and I'll be glad to help. So if you have enjoyed today's video, feel free to hit the subscribe button below and I'll talk to you soon, right? With that, wish you all good luck and good trading and see ya!